preparation of example which is little more real life. Sales, this is the P&L account where the sales is 720,000. We had expenses of raw material, staff cost, depreciation and loss of disposal of assets. These were the expenses coming up to 300,000, the operating profit being 420. I suggest just note down these numbers as we go on, it will become easier for preparation. The point to note here is depreciation of 118,000 is a non-cash expense. It is an expense where there is no cash outflow, as already explained. Similarly, loss on disposal of fixed asset of 18,000 is also a loss which is not where there was no cash outflow. Let us say the cost of the asset was 50,000 and after depreciating the net book value was 30,000. When the company sold it, it got only 12,000. So, compared to the net book value at which you were holding the asset, since you sold that asset at 12,000, there is a 18,000 loss. But this does not mean there is a cash outflow of that loss. I hope this concept, there is a net cash inflow of 12,000 because you sold the asset, but since the book, in the book you held the asset at a net book value of 30,000, there is a loss which you have to show, but there is no outflow because the initial outflow has happened when you purchase the assets itself. So, these are non-cash items within the profit and loss account. So, the operating profit was 420, from which you lessen the interest that has been paid, which is 28,000, arriving at profit before tax of 392, and there is a taxation amount of 124, and that has been assessed to be paid for the current year. This also figure that you should note, 124 is the taxation amount that has been assessed, it has to be paid, and the profit after tax is 268. So, this is the profit and loss account. Now, let's look at the balance sheet. This is the first year and the next year, and the changes have been shown here where fixed assets have changed. There is a minus 58 from year X1 to X2. As I said before, assets can be slightly misleading because the depreciation angle is not completely provided in the balance sheet, and the profit and loss account you might have to go through the schedule actually to assess that. So, we will take this data from outside from the company to find out what was the actual investment in fixed assets and how much they had actually invested really. Now, as far as current assets is concerned, it has increased from 20 to 24. That means increase in asset is a use of funds. Similarly, trade debtors has increased from 50 to 66, which is again a use of funds. If you take bank balance, the bank balance has reduced from 56 to 48, which is a decrease in asset and therefore a source of fund. Similarly, if you take liabilities, there is an increase in liability as far as trade creditors or accounts payable goes, and therefore that is a source of fund for you. The taxation amount has also increased from 78 to 92. This will be also a source of fund, but taxation we have to keep in mind that we had a figure of current year taxation of 124. I told you before, we already have an outstanding balance shown at the end of X1 as 78. So, 78 plus 124 is the actual payable, and at the end of X2, 92 is the amount that still remains to be paid. That means 124 plus 78 was the total payable, out of which some amount was paid and the balance was 92. So, this is a calculation that you will have to do separately. We cannot just directly take the increase and put it as a source of or use of fund. So, net current assets therefore has a change, and the total assets are, which were 1378 at the end of X1, is now 1312. We carry forward this just to keep the number here, and then we look at what happened to the liability. The loan amount changed from 500 to 200, means there was a payment of 300, and therefore it was a use of fund, and the net asset figure after this gives you that is the gross assets minus the long term liability, this figure, which then was funded by the owner's equity to the extent of share capital, which again increased by 20, share premium increased by 12. So all these were sources of funds, and profit also increased. The loss, that was retained profit, increased from 515 to 716, which is also a source of fund. Additional data that has been provided is a dividend of 66,000 was paid, and also 90,000 was paid towards a new machinery, and fixed asset worth 12,000 was sold. I hope you have noted down all the figures so that when we arrive at the cash flow statement, it will become easy for you to compare what we are talking about. Let's move on to actually creating the cash flow statement. As I said, the first part is to find out what is the cash flow from operating activities. So what are the operating profit? We started off with operating profit of 420. We add back depreciation. As I said, depreciation is a non-cash expense, therefore we added back. Loss on sale of fixed assets, I explained to you that loss of sale on fixed asset is actually not a cash outflow, and therefore that is added back. An increase in stock from 20 to 24 is a use of fund, so we need to reduce it. An increase in debtors is again an asset increasing, therefore a use of fund, we again deduct that. Increase in creditors, an increase in liability is a source of fund, and therefore we add that increase. The interest that we are paying is a use of fund, therefore we reduce that. Now tax paid, I explained to you in the beginning of the opening balance of balance sheet was 78. We added the charge for the year, the tax to be paid for the year was assessed to be 124. So total tax payable was 124 plus 78, and the tax that was payable, as we found out in the balance sheet of 31st March of X2 was 92. So when you add these two and subtract 92, you can find out that the actual tax paid was minus 110, that is, it was a use of funds. After that, dividend which was paid is minus 66. So the net cash flow from operations is a positive 338. When you add up all these, you get a positive 338,000 rupees, which was the cash flow from operational activities. From the investing activity perspective, we had the data that a machinery was bought, therefore an increase in asset, which is minus 90, it is a use of fund. Similarly, receipt from sale of fixed asset, inflow of fund, which gives you a net outflow from investing activities of minus 78,000. Cash flow from financing activities, when you issued share capital 20 plus 12, which was a source of fund, and a loan was repaid 500 minus 200, which is a use of fund of minus 300. So net cash flow from financing activities was minus 268. So we had 338 from operating activities, minus 78, minus 268 from the cash flow from investing and the financing activities, giving us a net cash flow during the year, that is A plus B plus C, giving you minus 8. And this minus 8, if you see, change in the bank balance was 56 to 48, and therefore we have seen how the bank balance changed from 56 to 48 because of the various activities that took place. So this gives us a better insight into how the company operated during the year, how much operating cash flows came in, how much of cash flows came in or went out net because of the investing activities, and how much funding it additionally took from the outside funders, which is your shareholders as well as other institutions which could have given them loans, and therefore arrive at how the overall picture looked like, which gives you a better insight than just looking at the profit and loss account in terms of cash flow. So what are the major advantages? As we have derived the cash flow statement, I think we would have understood that the lifeblood, because you may make profits, but if you don't have the cash to pay and your cash inflow doesn't come in, the business will not be able to continue. So this is the lifeblood. The movement of cash is very important. The second point, of course, is cash flow is real. I mean, there are no rules and conventions and accounting concepts by which you go. So therefore it is a real thing, and cash flows therefore represent the reality of the business. And the third aspect obviously is that since these accounting conventions and concepts are not applied, you can easily compare companies using cash flow as a barometer and know which companies probably are performing better than the others, a cash flow giving you a much better insight into it. So, what are the advantages when we look at the cash flow statement? What all we can do? It gives us an ability to assess actually, it gives us an ability to assess if the company can generate positive future net. See, the cash flows have to be analyzed over a period of years and see how much of operating cash flows have they gone on increasing over a period of time. It is always good to have a company which creates more and more cash out of operations, which means the profits are really coming in the form of cash and therefore moving into the company, available in the company for its future growth, and therefore generating positive future cash flow is a very important aspect that we can judge looking at the cash flow statement and making some projections from there on. The other is it in a position to meet its obligations? Is it sufficiently generating cash to meet its loan payments, its dividend payment obligations, and so on and so forth? These are something that we can make an assessment on based on the cash flow statements. We can also say by looking at the operating cash flows, if they are falling, they are dwindling, we can also make an assessment that probably this company is now going to require more and more of external funding. We can also look at the expansion plans of the company and look and see how much of it can come from the operating cash flow and how much they will have to go outside and borrow. These kind of assessments also we will be able to make. We can also understand the difference between the profit and the cash basis income. Why there is a difference, where the problem or the positive side of the businesses. Are debtors paying on time? Is debtor conversion into cash happening in a reasonable way? Is the company paying cash to its suppliers, or it is holding back? These kind of analysis can be done to understand the difference between the profit using the accrual method and the cash basis income. So, overall cash flow statement gives us further edge in the analysis and understanding of the financial position of a company, apart from looking at the balance sheet and the profit and loss account.